Okay, somebody's officially in charge of reminding me to record if I forget. Um, if you have gap issue, you would go from unmodified to qualified. For example, we had the example where your buddy asked you to tell them what their outfit looked like, and on the day of the you went to look, you said, well, what shoes are you going to wear on the day of the interview? And they said, oh, I'll get the shoes later. And so now you're going to qualify your opinion. You say, well, your outfit looks fine except for what I've been able to tell you had I been able to see the shoes. There was some procedure you can perform to support your opinion, right? Well, auditors work the same way. Hey, I'm supposed to sit here and I'm supposed to confirm accounts receivable. I was not able, for whatever reason, to confirm accounts receivable. I'm going to give a qualified opinion. And if those problems go from bad to worse, okay, on the gas side, the auditor goes from qualified to disclaimer. And a disclaimer, the auditor is shrugging their shoulders saying, I don't know. There are so many procedures I couldn't perform, I'm not able to tell you, or the procedure I was not able to perform was so pervasive that I have to disclaim an opinion. The auditor says, I just don't know if the financial statements are fairly stated or not. Notice that is different that when we're on the gap side, we go from qualified to what? To adverse. Adverse is where you have just determined the financial statements are not fairly stated. The auditor is actually crying there. Okay. All right. So that was sort of what we had talked about last time. And now we're going to dig in here. The reason we're kind of highlighting and showing in full blown color, not grayed out, the gas issue side, because we're going to start to see now, well, how does the structure of the report change when we are qualified or disclaiming? Okay. Now, it is important that we remember that when we are going from with gas problems, we don't go from qualified to adverse like we do on the gap problem. We go from qualified to what? To disclaimer. And we're going to actually look at a question where they'll say the auditor would decide between qualified and disclaimer for what? And it's going to be because there's some sort of scope of the audit issue. Okay. Now, when we look at the scope of the audit and limitations on the scope that are going to affect our either gas qualification or disclaimer, the problems are generally either by circumstance or by client. Okay, they can be brought on by circumstance or by client. Okay, and they used to call out by client, but now they call it cause of scope limitations, circumstance, or I guess these days they call it management imposed. They used to call that client, okay? But management imposed or circumstance can cause a limitation, okay, in the scope. So let's take a look at a couple of examples. And we say what? Until inability to obtain appropriate evidence, the inability to observe inventory, okay? Now that would probably be an example caused by circumstance, okay? It may be caused by circumstance beyond the control of either the auditor or the entity. For example, say we were engaged and we were engaged after the start of the year. Well, for that reason, we may not be able to observe the beginning inventory. Okay, so what happens? Let's say they hire us. Company has a calendar year end, 12/31 is the year end. And let's say they hire us on, and I'm going to make it, they hire us on 2/1. This is 2020. They hire us on 2/1/2021. Now they take the ending inventory at what? 12/31/2020. So we would have a problem in that we couldn't see the ending inventory 12/31/2020 because we weren't brought on board until February of the next year. Well, the problem that you have is what? Last year's ending inventory becomes this year's beginning inventory. So let's say we want to look at the income statement. And let's say the income statement reports cost of goods sold, which they often do. Can you see a problem with our ability to give an opinion on the income statement based on this circumstance scope limitation because we weren't hired until 2/1/2021? Let's say we weren't hired until 5/1. Let's change that up a little bit. Let's make it 6/1/2021. Can you see a scope imposed, a circumstance imposed scope limitation with our ability to give an opinion on the income statement? That's a question. Let me ask another question. You know how to calculate cost of goods sold? I'm not going to ask a much easier question than that, guys. If you don't know how to calculate cost of goods sold, we need to talk because you're not ready for the CPA exam.
It's beginning inventory plus net purchases minus ending inventory.
Good. Beginning inventory plus purchases gives us what? Goods available for sale, right? Minus what?
Your ending inventory.
Good. Minus ending inventory will give us the cost of goods sold. Now, what's the date for the beginning inventory, assuming a calendar year? That would be 1/1/2021. Ending inventory is going to be what date? 12/31/2021. Okay, good. So what happens? Did we apply the required audit procedure to observe inventory at 1/1/2021? No, because we weren't hired until what? Until 6/1/2021. You know, now sometimes students will say, well, even if you came in January of 2021, well, if we're having enough of a relationship with them to sign on as their auditor by 1/1/2021, we probably would be able to work something out for 12/31/2020, right? But in this case, we didn't come around until June. And since we didn't come around until June, we have a little bit of problem in that we can't really get a good opinion on cost of goods sold, which is reported on the income statement, okay? So what we might want to decide is, should we qualify? Or, and this is a matter of auditor judgment, guys. There's nothing in the standard that says when you have to qualify. I shouldn't say there's nothing. There are limited times in the standard as to when they say we have to qualify versus, and we're going to decide between qualify or disclaim. And that's on the income statement. How about the balance sheet? Can we give a unmodified opinion at the 12/31/2021 balance sheet?
I'd say no.
You say no because
we can't verify the beginning inventory. I know that much.
okay, but beginning inventory isn't really reported on the 12/31 balance sheet, is it?
No, it is.
So for that one, Matthew, we could probably give an unqualified, unmodified. I'll just use the non-public wording there. We could probably give an unmodified opinion on the balance sheet because what? We're there at 12/31/2021 when they should have taken the ending inventory, right? It's the beginning inventory that's creating a problem, and it's creating a problem for the cost of goods sold because it's integral to the calculation of cost of goods sold. And cost of goods sold is generally a fairly important line item on the income statement, right? Analysts look at that particularly. So we might be aiming towards disclaimer. Again, it depends on the auditor judgment. We're probably going to qualify, and that was imposed by circumstance, nobody's fault. We just weren't hired soon enough to do this procedure to see the beginning inventory. How about statement of retained earnings? Statement of retained earnings is going to have what? Beginning retained earnings plus what? What do we add to the beginning retained earnings?
Net income.
Good. Add net income less what?
Dividends or distributions.
Good. Dividend. We'll just say dividend. Good. And that gives us the what?
Ending
Balance of retained earnings. So we're probably going to have to do what? Give an opinion or disclaim or qualify. Unmodified, disclaimer, or qualified. Well, can we give an unmodified? Let me ask it that way.
No, because we don't have to. We weren't there for the beginning of retained earnings.
Well, yes, but that's not the problem. But I like that. I feel the growth in the understanding here. But in this case, the problem is what? If I've already, say, disclaimed on the income statement, then how can I be comfortable with this integral part of the statement of retained earnings that is posted there, which is net income, right? So that would what? A disclaimer or a qualification on the income statement would probably bubble up to a qualified or disclaimer on the statement of retained earnings, because there's that big line item there called net income that's jacking things up. Now, Matthew, let's explore your point a little bit further. Let's say we were cool with net income. Then we could do what? Even though you're right, we weren't there for the beginning balance of retained earnings, because we're sitting there and we're saying, well, wait a minute, they're reporting an ending balance of retained earnings. We're cool with the what? With the balance sheet. We've given an opinion on the balance sheet, and that be ending balance of retained earnings. We know, and we can perform some audit procedures over dividends. Let's say we gave an unmodified opinion on the income statement, so we're good with net income. Well, we could add backwards and say, well, this must have been the beginning balance then of the retained earnings, and our audit evidence at that point is a calculator that allowed us to get to the beginning balance of the retained earnings, right?
Yeah, that makes sense.
Okay. And then how about statement of cash flows? Is there anything in this situation up here, okay, that we weren't, where did I write it? Okay. Did this circumstance up here affect our ability to generate an opinion on the statement of cash flows? What's the first thing you see in the indirect method of statement of cash flows?
Net income.
There's that annoying net income again. And that's sort of an integral part, because what? It pertains to a whole section of the statement of cash flows, the operating section in the indirect method. And even if I'm using the direct method, I still have to disclose the reconciliation of net income to cash provided by operations. So I've got another problem here, and then I'm probably going to have to do what? Qualify or disclaim now on the statement of cash flows as well, because the circumstances created a situation where I was not able to observe the beginning inventory. It causes scope limitation, right? Okay, good. Qualified or disclaimed. Now, let's change this fact pattern up a little bit. And let's say now, instead of being engaged on June 1st, we're engaged on February 1st, 2021. Does that change anything? What's the obvious thing it changes? What's the obvious thing it changes? Okay, would it make any difference if you were born February 1st or June 1st, do you think? For anything important in your life? Could you drink on February 1st, on February 2nd, if your birthday was on February 1st?
No.
You couldn't drink on February 2nd if your birthday was on February 1st, and assuming you were
backwards.
21? Yeah, so you could. So it does make a difference, right? So in fact, if you came in there on on January 31st, the bartender might give you a break. Okay, your birthday's tomorrow. Okay, I'm going to go ahead and give you a break, right? So the closer you are to the date, the easier it is to do something about it, right? So we might be able to talk to management and say, look, we weren't able to observe the inventory 12/31/2020, and we're supposed to do that. What we're going to propose is that you take the inventory today, February 1st, we'll set that up. We're going to take the inventory and we're going to back in to what it must have been on January 1st. And maybe you can do that because, you know, January is a slow month for them, and it's reasonable audit procedure that you would be able to back through the records and get to the January 1st. Okay, so what happens? There's always a chance to perform an alternative procedure. Now you say, well, why couldn't you perform an alternative procedure here? Well, maybe that gets too costly and too difficult to back through, you know, 6 months, I guess, or 5 months, whatever, of information, as opposed to back through 1 month of information. So 2 takeaways here, which is what? You can give different opinions on different financial statements. You can give an unmodified, unqualified on the balance sheet while you're qualifying, disclaiming on the income statement, statement of cash flow, statement of retained earnings. That's one takeaway. The other takeaway is if you can't perform a procedure, you can, in some cases, what? Perform an alternative procedure that will substitute the procedure that you couldn't follow. Now, let's say we tell management, okay, take the inventory February 1st. And we go back and forth and they say, no, no, no. What do we do? Well, now you might say, well, really, we have a scope limitation that is more imposed by what? By management. And now we're going to go ahead and we're going to have to what? We're going to have to qualify or disclaim an opinion because management has really imposed some limitation. They don't want to do the reasonable step, let's say, of taking the inventory again at February 1st. Outcome is the same. Qualified income statement, statement of retained earnings, statement of cash flows, or disclaimer. Maybe we can give an opinion on the balance sheet. Okay, question. Okay, good. So these scope limitations can come in because of management or because of circumstance. Now, if we are dealing with unaudited financial statements, okay, and now we're dealing with unaudited financial statements, and we're dealing with unaudited financial statements, and we're issuing a disclaimer, and the disclaimer is for not non-public. We're dealing with a disclaimer on unaudited financial statements for a public company. Now, how do I know that they're talking about public company here, even though they didn't call it out very effectively as a public company? Well, they tell me right here, an accountant who's associated with financial statements of an engagement that is conducted in accordance with PCAOB, Public Company Accounting Oversight Board. So even though the book didn't really do a good job of telling us they were talking about public companies up front here. The fact that they called out PCAOB, I guess we were supposed to realize that, but we also wrote it in up there. So this information here pertains to public companies when you aren't auditing the financial statements, but you become somehow associated with the statements, okay? And the disclaimer on unaudited financial statements, you have responsibility. You have to read the statements for obvious errors. The disclaimer may accompany the unaudited financial statements or may be placed directly on them. Unaudited, I don't know that that's something that they ask, but they should be contained in the same document. Unaudited should be clearly marked, and if the client refuses to correct an obvious error, then the auditor should withdraw from the engagement. Now we're going to see that there are similar rules for non-public companies. We're going to see that way out in A6 for non-public. Okay, so we have similar rules, and I'm not entirely sure. I understand why Becker decided to put it in chapter 1 for the public companies and chapter 6 for the non-public companies, but I'm not going to try to edit the book right now. I'm just telling you, if you have this situation where you become associated with the financial statements of a public company and you haven't had opportunity to audit those, these are the requirements right here. Okay, and so flashcard that. Okay, good. Now you come over and you take a look at the reports now. And what we're going to do on the next several pages is understand the structure of the report for non-public companies first, okay? And then we'll understand the structure of the qualified, disclaimer, scope limitation situation for the issuers, okay? So let's first look at issuers, the qualified opinion, okay? And let's flashcard these requirements, okay? Now, remember guys, last time, very important, I told you you had to memorize the standard unmodified report, right? We talked about that. And the reason we wanted to do that was so that when we have a situation that has come up, either a gap qualification, a gap adverse, a gas qualification on the other side of the chart that we were looking at a minute ago, a disclaimer, how do we tweak the standard unmodified? Okay, so when we say standard report, we're talking about what? We're talking about the unmodified report, right? Okay, that's what they talk about when they say standard. Standard is another way of saying unmodified, and that's the report that we are memorizing. If it's a public company, of course, we call that unqualified, okay? But let's just take a look. Since we memorize the what? Since we memorize the introductory paragraph, that's great because we don't have to change that at all for a gas qualification, okay? Management's responsibility paragraph does not change at all for a gas qualification, okay? Now notice something very, very interesting here, okay? Remember that I kept wanting to call it the orphan paragraph orphan sentence in the paragraph in the auditor responsibility paragraph, but then I just called it the lonely little paragraph that was down there by itself. And it said it forms the basis for our opinion is what we said in the unmodified report. But remember that for what? For a qualification, we can't say it is the basis for our report. We now say it is the basis for our what? For our qualified opinion. Now this is very interesting because we put the what? Basis, and it forms the basis for our qualified opinion. And we put that information there, but we don't tell you that it's a scope qualification, okay? So at this point, we're doing what? We're gonna make you sort of read that opinion to understand the reasoning. We have tipped off that what? In the auditor's responsibility paragraph, though, we have tipped off that it's going to be a qualified opinion. And so notice we are telling you in the auditor's responsibility paragraph that we have this qualified opinion. And then we give you what? The basis for the qualified opinion. And notice in the qualified opinion, which comes immediately before the opinion paragraph, and notice, guys, that pattern follows exactly what we saw for the gap qualification. But now what? It describes the problem. We weren't able to observe the inventory. We weren't able to see what was going on with the accounts receivable, whatever. I wasn't able to see my buddy's shoes because he hadn't bought them at that point. So notice here we have what? Qualified opinion, but they don't tell you if it's gas or gap. And it's not until you get into the basis for the qualified opinion that you start to understand, oh, okay, I see. It's because there was this scope limitation. There was this gas issue. And then the qualified opinion paragraph, and notice it says that what? Except for the possible effects for matters described in the basis for the qualified opinion. So you're saying here the possible effects because it's a qualification. It's a gas qualification. So now you're saying, except for what I would have been able to tell you about the possible effects of my buddy's shoes on his outfit, had he had them available for me to look at the day I looked at his outfit, and then you would say everything else is the same. So the pattern is very similar to the qualification for a gap issue, but what? But it's now describing that there's a gas issue, but you still put the except for phrase in the opinion, and you still have the basis for qualification heading, and that's where you describe what your scope limitation was, and then you qualify because of the possible excepts, but you effects, but you still use the phrase except for. Okay, so flashcard that again. Approach is memorize the unmodified, unqualified opinion, know how to tweak it for, last time we talked about gap qualification, know how to tweak it here for gas qualification. Question?
When we're learning how to modify it, we just need to get like kind of those key points, except for. We don't need to necessarily word for word.
Well, yes, you have memorized already word for word the unmodified, right?
Yes.
So let's say I gave you an exam question. I said, okay, write me an unmodified opinion. Write me the opinion, write a qualified opinion. Let's just do it that way. Write a qualified opinion for the inability to observe inventory. And you're going to sit there and say, okay, how am I supposed to do this? Well, good thing I memorized the introductory paragraph because I can write it exactly the same way. Good thing I memorized the management responsibility paragraph because I can write it exactly the same way. Good thing I memorized the auditor's responsibility paragraph, but I do have to remember to say not the basis for my opinion, but the basis for my qualified opinion. You have to call out the reason, right? Then you say, what am I supposed to do? Well, since I have qualified, I have to put a basis for qualified opinion in paragraph. You don't have to do that in the unqualified, because what? There is no modification, right? So here you just write, and it's probably the easiest of the paragraphs to write because you simply do what? You simply remember to write the paragraph. That's the hard part, but then you describe what the problem is. I was not able to observe the inventory, right? Whatever it is the problem is telling you is the problem, you write that in there. And then when you get to the qualified opinion, you just remember how you write it for the unmodified situation, but now you know that you have to include the phrase what? Except for the possible effects. And that's the strategy we take so that it's kind of like playing shortstop, right? What happens? You don't dig a hole and just sit there and stand in a hole because every ball is going to be hit to the same position, but you kind of use the same basic skills depending on whether you need to go to the left or you need to go to the right. So we've got the basic skills down, and now we're just sitting there knowing how to respond if The ball is higher, the ball is lower, it's to the left, it's to the right. We know how to respond.
Yeah, that makes sense. I guess I'm getting more so at like for a public company, of course, you have to give an opinion on the internal controls, and there's some language in there regarding that, and you don't need to worry about that word for word.
You need to worry about it, but not at this time. We're not talking about that right now.
Okay.
Okay, we're talking about the non-public company. How do we handle it? Non-issuer. We're going to talk about public company in a minute.
Got you.
This is non-public company. This is how we handle the situation. Okay. Question? I'm sorry? Did I hear a question? Okay. Okay, good. So let's go ahead and let's take a look at the example. Okay. And again, introductory paragraph, same as standard non-issuer report. Okay. Auditor's responsibility, introductory management responsibility is the same. Auditor's responsibility is the same, but now we say basis for our what? Qualified opinion, because we have to call it out as qualified. We add the basis of the qualified opinion, and then we just write up whatever it is that we weren't able to do in our opinion, except for the possible effects of the matter described in the basis for the qualified opinion. The financial statements present fairly. The rest of it is the same as the what? As the unmodified report, right?
Yes.
Okay, good. Okay, good. Now you come over and they talk about disclaimer. Okay, now I'm going to ask you to flashcard this. This is going to be a little more intense as to what we do if we have a disclaimer. Okay, and again, we're still talking about non-issuers. So, but we're still just going to flashcard the key aspects. First of all, we don't say we audited, we say we were engaged to audit, because if we're disclaiming an opinion, we don't want to say that we audited because we weren't able to do so. So we were engaged to audit. Management's responsibility paragraph does not change because of the now scope limitation that resulted in a disclaimer. Auditor's responsibility paragraph does change quite a bit. Our responsibility is to express an opinion on the financial statements. We were not able to. Okay, so that's kind of a big change. And the reason they changed that auditor's responsibility paragraph so much is they don't want you to call out, remember, that's the biggest paragraph. They don't want you to call out the nature of all the things that constitute an audit, because if a user of your report started reading that, they might start to get the sense that you're saying you did those things, when in fact you were not able to do a substantial amount of them that resulted in a disclaimer. So they really cut that wording down quite a bit. So on that flashcard for a disclaimer, you're really going to have to focus in detail on the language that goes into the auditor's responsibility paragraph. Okay. Then you put the basis for what? Not the basis for our qualified, but now basis for disclaimer. That's a pretty easy paragraph though, because you just write down whatever it is that they're telling you was a scope limitation. My buddy didn't even let me come to his house to look at his outfit. He wanted to tell me by the sound of his voice whether his suit looked right, so that everyone understands the pervasiveness of the issue that led to your disclaimer. And then you don't call it an opinion paragraph, you call it a disclaimer opinion. And notice here we use the more pointing word because of, right? When you're breaking up with somebody, you tell them because you did this, that's why I'm breaking up with you, as opposed to saying, well, I like what you do, except for I wish you wouldn't do that again in the future, or whatever, right? Here, you're using more pointed language because of, just like we saw when we were dealing with the adverse opinion. Okay, so flashcard that. So again, the approach is what? Know the standard, know the important tweaks as you move away from unmodified, unqualified to what? To qualified or adverse on the gap side, which we talked about last time, or disclaimer for the scope limitation. Okay. Okay, good. We don't need to spend a lot of time with that. Now, with that example, now let's look at the issuer situation. Okay, and let's just take a look at how the form and content of the issuer report will change when we have a gap issue. I'll find myself. Okay, so this is for our gas issues, I should say. Okay, so we talked about it for non-issuers. Let's talk about how gas issues affect the form and content of the public company report. Okay, so let's go ahead and let's flashcard again, focusing on how it relates to the standard report. And notice that we put the opinion section first. Remember, we talked about that last time. And the second sentence now is going to say, except for, with the exception of, and reference the paragraph that describes the departure from the, I don't know that they should have said departure from unmodified opinion, but whatever the work was that we weren't able to do. We weren't able to see our buddy's shoes because he hadn't had them yet. So you are going to basically be referring them to this paragraph. Okay. Now notice when you put this paragraph, there's no heading to it. You just stick another paragraph in there and it describes the reason that you're giving the gas qualification. Then you put the basis for opinion, but now it's going to say, this is the reason for the departure from the unqualified opinion, okay? And then you're going to go ahead and issue critical matters would be the same. Okay, so know how to tweak this. Now, was there a question, something about the internal controls or something? I wasn't sure how we were getting into that.
Yeah, I think when I was memorizing the unqualified and I looked at how it's modified for qualified on the gap side, I noticed that in the auditor's responsibility somewhere it talks about we had to look at the internal controls, and by means of testing we verified them and all that. I was wondering if we needed to memorize that language.
Well, that language was coming from the unqualified report. And so you still would have done those things. So yes, you'd still have them in here unless you couldn't do that either.
Got you. I'm thinking public versus non-public. That was the difference between those. I'm not even talking about qualified versus unqualified at this point, I don't think, but I understand what you're getting at.
Yeah, I mean, if you went back to the unqualified opinion issuer and you memorized it,
let's see, a basic opinion, such procedures include examining on a test basis, blah, blah, blah. If we only memorize the non-public, we wouldn't have that part memorized because that's different.
we conduct our honors course. Those standards require that we plan, perform the audit to obtain reasonable assurance about whether the financial statements are free of material misstatement, whether due to error or fraud. Our audit include performing procedures to assess the risk of material misstatement, whether due to error or fraud. And performing such procedures include examining on a test basis evidence regarding the amounts and disclosure of the financial statements. Our audit also include evaluating accounting principles and significant estimates made by management, as well as evaluating the overall. Where are you saying a discussion of internal control?
I guess I was mistaken. It's essentially the same. It's slightly worded differently, but it's saying the same thing. So I don't need to worry about it as much.
Yeah, well, the reason I'm spending the time to try to find it here, because it is true that it's worth pointing out that you do not have to give an opinion on the internal control when you're auditing a non-public company. Whereas if you're auditing a public company, you do have to do that. And then the two reports need to refer to each other. If you did it in a separate report, or you could actually give the opinion on the internal control in a combined report, but I'm not seeing it called out here, that requirement, unless I'm missing it.
Yeah, I should have highlighted it and seen exactly what I was looking at, but
Yeah,
I'm
I mean, these reports get harder to memorize these days than they were in the old days because they got longer. Okay. But the key is that you have to memorize both reports. For the
Okay.
non-public, the unmodified report for non-public, and then what we call the unqualified report for public, right? So once you memorize those two reports, and that's what I like to do is sort of word for word, then what we got into is, okay, this is what you do for a gap qualification, this is what you do for a gas qualification, and that you just kind of flashcard the key differences.
Okay, yeah, that helps. That's a good. I guess that's exactly the easy question. Do I need to memorize unqualified and unmodified? So yes, I do.
Yes,
That's
correct.
good.
Yes, the public
Got
and non-public, yeah. But then after that, just how do you address the differences, right? The
Fair enough. Thank you.
changes, how do you address the changes if you have to qualify or adverse, qualify or disclaim? That's the approach we're taking here.
Gotcha.
Okay, all right,
Sorry,
good.
I didn't answer the
No,
question.
no, it's, I think it's important that we come away with a structure of how to study this, okay? The perception or the expectation is that you've had exposure to this in a full-blown class at some point, and all we're doing now is figuring out how to structure our review of this material so that we're able to get, you know, a good grade on the exam, right? Okay, so yeah, those are all legitimate questions here. How do you want me to study this is a legitimate question that you maybe wouldn't ask as much in a regular class, right?
Yeah, I was just having a hard time wording my question. That was all.
Yeah, okay. Okay, good. So let's go ahead then. And we saw how to tweak it for a gas qualification for a public company. So let's see what happens when we have now a disclaimer. Okay, because remember, when our gas problems go from bad to worse, we end up with a disclaimer. Okay, and again, we do a little more flashcarding of the details here as opposed to the pattern, because the wording does change quite a bit for a unqualified if we're all the way down to a disclaimer now. Okay, so let's just flashcard some of these key things. Title will read disclaimer of opinion. We say we were engaged to audit, reference the paragraph that will give the reason for the disclaimer, okay? We were not able to render an opinion, and then you write the disclaimer of the opinion. Disclaimer of opinion has to have the words, we do not express an opinion. Then you put in an additional paragraph, even though you don't give it a heading, you just stick that paragraph in there, and that's the paragraph that they were saying you make reference to, and you just explain the reasons for your disclaimer, whatever it is, okay? Then you go ahead and you give the basis for your disclaimer, okay? And take out our responsibility to express an opinion, and eliminate that entire second sentence because you weren't able to conduct the audit. Okay, and you give your basis for your disclaimer. Okay, and then again, they annoy us with that critical matters thing. If everything's fine, add a critical matter to complain about. If everything's screwed up, don't put the critical matter in there because now you have a disclaimer. Well, then why was it a critical matter before, but now it's not, just because I went to a disclaimer, it's not. I'll bet you $1 someday they get rid of that stupid critical matters requirement because it's illogical. Okay, all right, good. But anyway, here we go. You give the disclaimer of the opinion. We were engaged to audit, but we weren't able to audit. We weren't able to obtain the evidence. Then you say what it was. Okay, here's our problem. Couldn't count the inventory. They decided to disclaim. And then the basis for the disclaimer, we could not audit it. And that was the basis for our disclaimer because PCAOB says we're supposed to disclaim when that happens. And then they omit the critical matters. Okay. Okay, good. Notice that if you are not independent, you don't say a whole lot. You cannot give an opinion on the financial statements if you're not independent. And so if you've somehow become associated with a set of financial statements that you are not independent for, you simply have to disclose that you are not independent. Okay, good. So with all that, let's go ahead and let's look at our first couple of multiple choice questions for tonight. And I'll give you a couple of minutes on this. Okay, so I'm going to go ahead and pause. Okay, so let's look at this, and I'm going to go ahead and end the poll. And okay, yeah, we didn't do too well on this one. Okay, so let's just take a look. Under which of the following circumstances would a disclaimer of opinion not be appropriate? When do you give a disclaimer of opinion?
When you were unable to perform some task that's part of the audit.
Okay, good. And so would that be a gap issue or a gas issue?
Gas.
Okay, good. So if that is a gas issue, then you have to decide between what? Between giving a qualified or a disclaimer, right? So it wouldn't be appropriate to give a disclaimer if we have a gap issue, right?
Yes.
Okay, so now we start to take a look and we say, okay, well, which one of these is a gap issue? And you look and says the auditor is unable to determine the amounts associated with an employee fraud scheme. Well, that sounds like a what? Audit scope issue, right? That might indeed cause you to disclaim. If I'm unable to determine, I'm unable to determine if my buddy's suit is appropriate because he wouldn't even let me come over to see his suit, right? Okay. Management does not provide reasonable justification for a change in accounting principle. Are they supposed to? If management wants to change their accounting principle, are they supposed to give me a justification for that?
Yes.
To be in accordance with GAAP?
Yes. For
Yeah,
GAAP.
GAAP says, hey, you just can't change your accounting procedure, your accounting principle because you want a bigger net income. You have to say, hey, it's better disclosure and da-da-da-da-da, right? Better accounting, et cetera. So that's a what? That's a gap issue. And if I have a gap issue like that, then yeah, I would be deciding between a qualified or an adverse, not a what? Qualified or a disclaimer. And then the rest of these are what? The rest of these are gas issues. If someone won't sign the management letter, that's a gas issue. They have to sign a management letter. If they won't sign it, that's a gas issue. Client refuses, that's what? A scope limitation imposed by management, isn't it?
Yes.
Okay. Okay, good. So that's how you look at that question, guys. And again, there's no reason to sit here and spend 3 hours just trying to ride the coattails of what you've perceived is going to be an easy A for you or something. That's not what we're here for. Okay. Okay, good. Let's go ahead then and take a look at the next one. recording button. And again, the management responsibility paragraph is rarely ever altered for anything. Okay, their responsibility stays the same. Okay. All right, guys. What I'm going to do is take a break right now because I feel like we're a little bit sluggish. Okay, so let's go ahead and get some coffee or something, or some water or some tea or something like that. And we'll come back and we'll pick up with module 7. Okay. Okay, guys, we're going to go ahead and get started back. Okay, please make sure you're following along. Make sure that you're attempting the questions as we go through. I don't want to become bogged down in, having to police that everyone's sort of doing what's expected here to get through the material and get yourself feeling comfortable about, how you're going to attack this stuff when you're ready to take your exam and stuff. Okay. This stuff is not, nobody wakes up in the morning and says, oh boy, I can't wait to, memorize a standard report and think about the structures of the report. But it is something that we have to work our way through. Asking about the reports is a good 10, 15 point area on the exam. There is no way to accomplish the goal of passing the CPA exam without slogging through this stuff. Okay, so hang in there. We'll get into some things that are maybe a little more interesting when we start talking about the procedures to support the report, but we've got to get through this stuff to be making sure that we're able to pass the exam, right? Okay. All right. So what we're going to do now is we're going to sort of turn back to the discussion of our unmodified, unqualified reports. But now we're going to see that there's something important that the auditor wants to talk about in the unmodified report. It's not something that's so significant that it resulted in a qualified or adverse or qualified or disclaimer. The report is still unmodified, unqualified, but we're going to add some information. Now, adding that information falls into two categories. One you see here is emphasis of matter. The other you're going to see is called other matters. We'll get to that. Now, the difference between emphasis of matter and other matters is this. Emphasis of matter is something that the company already disclosed in the financial statements. So they already put a footnote or something about that in the financial statements. But the auditor thinks it is important enough that it should also be included and discussed in the auditor's actual report. And we're going to tack on an emphasis of matter paragraph to the end of our standard memorized, unmodified, unqualified report that will explain what that issue is. Okay. Now, you could also have other matters. Other matters, still, the report is unmodified, but for whatever reason, the entity didn't have to disclose that in the financial statements because GAAP didn't require it. But for some reason, the auditor has decided, hey, this is important enough that I'm going to include it in my report. Okay, again, the reports are still unmodified here. Okay, so emphasis of matter, other matters. And we're going to see that the standards instruct the auditor as to some circumstances where you must include an emphasis of matter. Other times they say you can if you want to. Okay, same thing with the other matters. Sometimes you have to provide the other matters. Sometimes the standards say the auditor can provide it if they want to. Okay, that's where we're going with this discussion. So let's just take a look. Emphasis of matter is included in the auditor's report when required by GAAP or at the auditor's discretion. An emphasis of matter is used when referring to a matter that is appropriately presented and disclosed in the financial statements, but of such importance that it is fundamental to the user's understanding of the financial statements. Okay, very important. The inclusion of an emphasis of matter paragraph in the auditor's report does not affect the auditor's opinion. Again, it is still going to be an unmodified for non-public company, unqualified for public company, but you're going to have to include that emphasis of matter. Now, let's first look and let's flashcard the structure of where that emphasis of matter report is going to appear. And again, we're going to discuss where it shows up based on our understanding of the modified opinion. So when an emphasis of matter paragraph is included in the auditor's unmodified opinion, the auditor should place the emphasis of matter paragraph immediately after the opinion paragraph. So we'll have that opinion paragraph, and then here comes the emphasis of matter paragraph. Okay, it'll use the heading emphasis of matter. It'll describe whatever the matter is that's being emphasized, and it'll indicate that the auditor's opinion is not modified with respect to that emphasis of matter. So you're still issuing an unmodified opinion, and now you're just emphasizing a particular matter down there in that emphasis of matter paragraph that has to follow this requirement. You could have an emphasis of matter in a qualified opinion. You can still stick it down there, but that is not the reason that you're qualifying the opinion when you do that. Okay, it comes after the opinion paragraph is something additional that you're emphasizing that is already disclosed in the financial statements. Okay, now as we set up there are times where the emphasis of matter is required. Okay, so let's just go ahead and flashcard these reasons, and I'm not going to fill in these bubbles here. I'm just going to go ahead and take a look at these reasons that the emphasis of matter would be required. If there is what substantial doubt about an entity's ability to continue as a going concern. Okay, so if you think a company is going to go out of business as the auditor, you've looked and you've seen concerns about their ability to continue, that you think they're going to go out of business, what do? Well, it's not a violation of GAAP or a scope limitation for a company to go out of business, but do you think that's pretty important? Yeah, so there would be an expectation that the company would have disclosed that, and the auditor will raise that, will be required to raise that to the level of the auditor's report as well by indicating an emphasis of matter that would come after the end of an unmodified report. The financial statements are fairly presented, but unfortunately, they're presenting to you a company that's about to go out of business. Okay. If there is a change in accounting principle, okay, it doesn't say that you can't change the accounting principles. A company can do that. But when they do, we will have to add an emphasis of matter paragraph to our report saying, hey, this company was using a completed contract method for their contracts before. Now they're using percentage of completion. And we would have to call that out and refer to a footnote that describes that change. Again, it's an emphasis of matter. Okay. If there was a subsequently discovered fact to change the audit opinion, and this one could be an emphasis of matter or other matters depending on whether or not that has been disclosed in the financial statements. But if you had issued, say, a qualified opinion in year one, but by year two, the company had corrected that, and you were preparing comparative financial statements, then you might want to call out that, hey, I've changed my opinion on last year's statements from qualified to unmodified because they corrected the error, but they would expect you to call that out in an emphasis of matter because, again, that's pretty important. You know, I think the expectation is generally that the company would have included a footnote on that. But if they did not include a footnote on that for some reason, then of course it would be under the other matters heading because emphasis of matter is used for something that has been properly disclosed. Okay. And then the financial statements are prepared in accordance with an applicable framework, other than when it's for regulatory basis and it's being distributed for general use. And we'll get into that more in A193. You'll see how that kind of stuff works. So I wouldn't worry too much about that one now. We'll have some more examples about it, okay? So these are times in which the emphasis of matter, auditor doesn't have to use any judgment. Bam, it's required that you provide this when you have these things going concern, changing accounting principle, etc. Okay, now it may be necessary, and I'm not even going to ask you to flashcard this because, hey, if the auditor decides that there is something important enough that would require the emphasis of matter, there's nothing stopping the auditor. Don't you dare put emphasis of matter. That's a judgment thing, and the auditor can put the emphasis of matter in there for a circumstance like that. Okay. All right. Hang on a second to look at the next one here. Sorry, guys. I get different levels of sunlight in here, and then this room starts to get too dark for me, and then it's too light. Okay. All right. Okay, good. Now let's come down and let's look at other matters. Again, as we have stated, other matters come up when it's something that is important enough that it should be included in the audit report. It's either required or at the auditor's discretion, but it is something that is not necessarily presented and disclosed in the financial statements. Okay. Now, obviously, if they were supposed to put it in there and they didn't, that would generate what? That would generate a qualified or adverse. So this is something that they're not required to disclose. They did not disclose, but the auditor has determined it's important enough fact that it needs to be included in the auditor's report under the other matters, or we are required. Okay. Now let's first look at how it will look in the report. And they tell us we place the emphasis of matter after the opinion paragraph and after the, we put the other matters after the opinion paragraph and after the emphasis of matter. So unmodified report, we've got the structure memorized, intro, auditor's responsibility, basis for our opinion, management's responsibility, basis for our opinion paragraph, auditor's responsibility paragraph, then what? Then the opinion, then we have what? Emphasis of matter, then we have other matters, okay? We have to use the heading other matters, okay? So keep this flashcard going onto the next page, okay? So that's gonna continue on to the next page, okay? And then we have what? When, so that's all you need. Actually, that flashcard doesn't keep going, sorry guys. That's all I want you to put on the flashcard there for that. And then when is the other matters paragraph required? New flashcard, okay? And it is required, and they have quite a list here. So let's start to take a look at these other matters, okay? Anytime the auditor includes an alert that restricts the use of the report. Sometimes you will come in and you could be asked to audit financial statements that use some sort of specialized accounting, like a regulatory basis of accounting. And if that's the case, you're going to say, hey, this report is restricted to individuals who understand the nature of what this financial statements are all about, and you restrict the use of those reports, okay? Subsequently discovered fact that led to a change in the opinion would be what? Emphasis of matter if the entity had disclosed that they changed the principle. If the entity didn't disclose that they changed the, or a subsequent discovery fact changed something, if they didn't disclose that, not the principle, but if they hadn't disclosed a subsequent discovery fact that led to the change, then it would go under the other matters paragraph. So subsequent discovery fact could be emphasis of matter, other matters, depending on whether or not it was disclosed by management. I would think that most of the time management would disclose those and it would be under emphasis of matter, but in the off chance they weren't required to and they didn't, then you would put it under other matters, okay? Financial statements of a prior period were audited by a predecessor auditor, and the predecessor auditor report is not reissued, okay? So if that's the case, you're gonna add an other matters paragraph, and we're gonna see later that all you'll do is you'll summarize in that other matters paragraph what it was that the other auditor said about the entity's financial statements. So say you audited year one, I audited year two, we didn't present your report from year one, I would simply summarize in an other matters paragraph on my report for year two what it was that you said about year one. Okay, we'll talk more about that. Okay, again, all we're flashcarding here is when the other matters paragraph is required. Okay, next one, current period's financial statements are audited and presented in a comparative format with compiled or review statements, or in comparative format with prior period financial statements that were not audited, reviewed, or compiled. And again, we'll talk more about this, but basically, so we're just listing the reasons that we have to add the other matters paragraph. When are we required to do that? But just to give you a look forward is when we're going to talk about the specifics on this. It's a problem if say I audited year 2 and the company is preparing a comparative format statements from year 1 and the year 1 statements weren't audited at all. It could be what? It could be dangerous to the user, the financial statements, because they start to think everything got audited. So what do? To protect against that potential misunderstanding, we add an other matters paragraph that says, hey, of the 2 years you're looking at side by side, the only year that was audited was what? Was year 2, year 1 was not audited. Again, important fact information that the auditor is making available as soon as the user reads the report. And if it wasn't disclosed by the client in their financial statements, then we'd put it under other matters. Okay, let's keep going. Let's look at the next one. Prior to the audit report date, the auditor identifies a material inconsistency and other information that is included in a document containing the audited financial statements. So there's a inconsistency with the financial statements, which we've given an unmodified, but the financial statements are contained in a document that is inconsistent with what is being shown in the financial statements. And you're like, well, what the hell is all that? Okay, so let's just come down and let's just draw ourselves a little drawing here. Okay, so we have an annual report. Okay, and then in the annual report, what happens? You go to the back and they have the financial statements. Now, the auditor's opinion is on the financial statements, not on the rest of the annual report. So the auditor's opinion is on those financial statements, not on the annual report. But we're required to read the annual report and see if there's a material inconsistency between what's in the annual report and what we're seeing in what we know to be the facts based on our audit of the financial statements. So let's say they say, well, revenue was 5 million in the annual report. And then we look and we're like, well, wait a minute, we audited the financial statements. The revenue wasn't 5 million, it was 500,000. What would you do? We're not auditing the annual report. We're auditing the financial statement. We're satisfied that the revenue is correct on the financial statement, but in the annual report it's saying 5 million when we know on the income statement it says 500,000. What would you do?
We'd put in other matter paragraph and disclose that's different on the on the annual report compared to what we know.
Good. Yeah, that's correct. Now, as a practical matter, Matthew, thank you for that great answer. But as a practical matter, we would do what? We'd first point it out to them, right? Because maybe they just forgot a comma or a zero or whatever, right? And they're sitting there saying, oh, thanks. Geez, let's fix that. But if we call it out to them and they say, well, we ain't fixing it and you can't tell us what to do in our annual report, so then we would what? Call out that material inconsistency between the financial statements in this annual report, because our financial statements or our opinion on those financial statements are right there contained in the same document, right? And we want to guard and make sure that everyone understands we've noticed that inconsistency and you should too. Okay. Okay, good.
Opportunity to fix it, basically.
You would ask them to fix it, but we can't force them to fix it because we don't have jurisdiction over the annual report. We could withdraw from the engagement, but now we just spent all this money on the engagement and, there's nothing wrong with the financial statements. So we're just going to what? We're going to call you out publicly in our report saying, hey, I don't know what they're doing with that annual report. You might want to check this out. Okay. So what you want to do, and that probably would compel them to change it then, right? Is see page A1. We're not going to go now, 86, and we'll talk more about that when we get to, I think it's item 1.2.2, and we'll talk more about that later. Okay. Okay, good. Now, when the auditor chooses to report on supplementary information presented with the financial statement in the auditor's report rather than in a separate report. Okay, so what happens? We have the financial statements, but sometimes GAAP says that they want you to supplement the financial statements with other information, okay? For example, if you do an audit according to the Government Accounting Standards Board standards, you are required to provide a management discussion and analysis that supplements the financial statements. Now, what happens? Well, we're not required to audit that information, okay? But what happens? We would want to know that they at least provided it. And if they provided it, then we would look to see that it's provided, and we would refer to that information. Okay, so the auditor, if we chose to give an opinion on it, we could, and then we would call out that there's a separate report that gives an opinion on that information. They probably should have flipped these two bullets, but we do need to at least look to see that it was there, and then we would refer to it in the other matters paragraph saying, hey, the supplementary information they're supposed to provide is there. And then the bullet before that, if we were engaged to actually give an opinion on it, we don't have to, but if they asked us to give an opinion on it and we issued a separate report that gave an opinion on the supplemental information, in the other matters paragraph, we would have to point to that other opinion we had. So we don't have to give an opinion on it, but we do need to look to see that it's there and refer to it. And if we're asked to go even further and give an opinion on it, then we would point to that opinion, assuming that that was prepared in a separate report. Okay, so that second situation, and I feel like they flipped the order that they should talk about these, but that second bullet there is provided on page 91. The discussion is there, 3.2.1, and this one is provided on page 86, A1 86. Excuse me, A1, my bad, A188, page 2.4.1. Okay, so we'll show you what that stuff looks like later. Again, supplemental information is required. As auditor of the financial statements, we look to see if it's there, and we mention, hey, it's there, okay? And if the client wants us to, we could go further and actually give an opinion on that information. And if that's the case, and that opinion is separate from the opinion on the financial statement, we have to say, look for that other report out there in which we give an opinion on the supplemental information. Okay, and then this last bullet, to restrict the use of the auditor's report when special purpose financial statements are prepared in accordance with the contractual or regulatory requirement, unless it's for some sort of general use. And we'll get into that in A194, and we'll talk more about that. Okay, so if you're sitting here saying, John, I don't have the F you're talking about with these things, that's all right, because we're going to look at them some more. All you're doing with this flashcard right here, right now, is listing the times that you're required to do what? You're required to give another matters paragraph. And we're going to get more into these when we get into these later pages. Okay? Okay, good. And then they tell us that an other matters paragraph, okay, may be necessary in the following circumstances. Describe reason why the auditor cannot withdraw from the engagement, or when generally accepted practice require or permit the auditor to provide further explanation of the auditor's responsibilities. That's when it may be necessary. Now, go ahead and flashcard those, but you say, well, why would I not be able to withdraw from the engagement? And I'll give you an example in an audit I was involved in. Involved in the audit of the consolidated financial statements of the federal government when I worked for the Government Accountability Office, GAO. I was involved in the audit of the IRS financial statements. I was involved in the audit of the public debt financial statements, okay? And GAO audits those pieces of the consolidated because legislation, the CFO Act says that the GAO will audit those financial statements. Well, if the CFO Act says that the GAO has to audit those financial statements, how can we withdraw? There's a regulation that says we will audit those. So there are cases where something like legislation calls out specifically who the auditor is supposed to be. How do you withdraw from that engagement? You cannot. And that may be the kind of thing that you want to add as an emphasis of matter. Okay? Okay, good. Come over. Not an emphasis of matter, excuse me, other matter. Huh?
The last one under of the use required for other matter paragraphs. I don't think we covered that. I'm not sure if there's anything special to say on that. It's pretty self-explanatory, but.
Well, there's nothing under there because you're not required to talk about that.
No, I'm saying under use required, that last bullet point, a report on compliance is included in the auditor's.
Oh, I see. You're saying I missed one. Oh, okay.
I'm sure if you have any extra notes on that, or that's pretty self-explanatory. But
No. A report on compliance is including the auditor's report on the financial statements. You could be engaged to give a report on the entity's compliance with certain laws and regulations. And if you do that, then they require that there be an other matters paragraph that talk about your responsibility there.
Gotcha.
So I just flat out missed that one. I mean, again, I'm asking you to flashcard these and memorize these because you might get one question when they ask, when are you required to do this? Provide the other matters, and why not have a flashcard on that? Remember, with the flashcards, we're doing two things. We're looking at them before we work any multiple choice questions so that we, maybe get those right while we're working our homework questions, where you might see a lot of questions like that. So you kind of keep repeating that. Oh, okay, you got the question wrong. And you realize, oh, that's right. We had that flashcard that said I'm required to have other matters paragraph in the situation. That's right. That's right. Making grooves in the brain. You keep looking at that flashcard. Remember I said, hey, look at the flashcards up to you're walking into the exam. Now it's in there and you see that one question, bam, yeah, got that one. Now that's not in and of itself what's going to allow you to pass, but it avoids a situation where a bunch of little shit like this gangs up on you and cost you a couple points that would have allowed you to pass. Okay, good. So that's what we're doing with this stuff. Okay, let's go ahead and let's take a look at what happens. And now, rather than call it out as an other matters or emphasis of matter, now they simply call it explanatory paragraph, okay? But we're going to take the same approach is when is the explanatory paragraph required, when may we have it, okay? And the reason we've changed the name of it to explanatory paragraph is because we're talking about issuers. So an explanatory paragraphs including the auditor's report when required by PCAOB or at the auditor's discretion. Its inclusion in explanatory paragraph in the auditor's report does not affect the auditor's opinion. In other words, it's not going to cause you to modify, to qualify your opinion. It's not resulting in a disclaimer or a adverse opinion, nothing like that. It's just something that they're telling us we have to provide it. Now, how do we provide it? The explanatory paragraph generally should be included as appropriate, and the paragraph should describe the matter being emphasized and location of relevant disclosures about the matter. The explanatory paragraph will generally follow the opinion paragraph when added to the unqualified opinion. So flashcard that's the location. It goes after the opinion paragraph. Use of explanatory paragraph. When is it required? Substantial doubt about an entity's ability to continue as a going concern. So you're going to see some parallel here between public and non-public companies. There's been a material change between periods in accounting principle. You see the similarity, right? There has been a change in reporting entity. This can come up if, let's say, in year one, you didn't include in consolidation certain companies that were under the same common ownership, or they acquired some additional companies. What you'd be required to do under GAAP is you would be required to restate the previous year statements to show what they would have looked like had you consolidated the same set of companies in year one that you're now consolidating in year two, because now they're under the same ownership. When you do something like that, that is significant enough that, hey, accounting standards have said we're supposed to do this, and the auditing standards are telling us what? You got to call out that you restated the statements under a situation like this, okay? There's been a change in the investee year that has a material effect, okay? A material misstatement, a previously issued financial statement has been corrected. Other information, a document containing the audit financial statements is materially inconsistent. Are you seeing the similarity here? Okay. Selected quarterly financial information required by the SEC has been omitted. Supplementary information required by an applicable reporting framework has been omitted. Okay. The prior year audit is not presented. Audit report is not presented. The prior year opinion has been updated. Management is required to report on the entity's internal control of financial reporting, but such report is not required to be audited. Okay, all of these are reasons as to when. Now, for public companies, the other matters paragraph would be required. Okay. Okay, good. Come over. Use may be necessary at the auditor's discretion. Okay. Okay. Again, guys, not the most scintillating, interesting. Hey, guess what, honey? I had such a enjoyable discussion in my class tonight. These are the reasons that another matters paragraph is required. These are the reasons emphasis matters. In public companies, they just call it explanatory paragraph, but the reasons are very similar. I mean, I get it, not very interesting stuff, but I'm asking you to make flashcards on those things so that you, are in good shape to get the answers correct for the 1-2 questions they'll ask you there. Okay. Now, here we talk about lack of consistency, and the word lack makes you think that it's a mistake. No, company can change their accounting principles. Okay. Now, the assumption is we don't talk about consistency of using the same financial statements from period to period because it's assumed that the company will use the same accounting principles from period to period. Okay, so generally we assume that that's going to be the case. Now, it is okay though for a company to change their principles, and if they do, the auditor will need to call that out as we've seen, a emphasis of matter paragraph. But that's the case if the company has been acceptable in the way they did the change. If not, then they haven't followed GAAP, and we're going to give them what? A qualified or adverse opinion. Okay. So what makes the change acceptable? And the change is acceptable if the newly adopted principle is in accordance with the applicable framework. The method of the change is acceptable. They've done the proper disclosures related to that, and the entity was justified in making the change. If they satisfy all 4 of those criteria, then we only need to include emphasis of matter for a non-public company, explanatory paragraph for a public company, and we're good to go. If what? If any of the criteria are not met, then that's going to be what? That's going to be a non-compliance with GAAP, depending on the pervasiveness, qualified, or adverse. Okay, so flashcard, what makes the changes acceptable, and then flashcard that if they don't meet any one of those, then we're going to have to qualify. But assuming they met all of those, okay, then we would go ahead and just give them the emphasis of matter / explanatory paragraph. Now, what are the kinds of things that could lead us to talk about a emphasis of matter explanatory paragraph in which there's been a change in principle that is acceptable? Okay, so let's just flashcard these. Change in accounting estimate that is inseparable from a change in accounting principle. Okay, so if that's the case, you should add the emphasis of matter. And they give us an example here called change, and they say change in depreciation method. Okay, so what's going on here? So accounting standards say that if a company changes their method of depreciation, that is actually a change in estimate, not a change in principle. That's what the accounting standards say. What happens? I'm using declining balance, say double declining balance. If I use double declining balance, I'm telling you that the asset depreciates what? Quickly in the early years and more slowly in its later years. Let's say after about 3 years on a 10-year life, I decide, you know what? I'm going to use straight line for the last 7 years. Well, that sounds like a change in accounting principle, doesn't it? But FASB said, no, that's a change in estimate. You're not saying now anymore that the asset depreciates quickly in its early years and later, slower in its later years. Now you're saying it depreciates evenly over its entire life. We're going to treat that as a change in accounting estimate. That change in accounting estimate is not a change in accounting principle. The auditing standards say, we don't care. We're still going to make you include the emphasis of matter explaining paragraph that talks about that change, because it is a change in principle that is indistinguishable from a change in estimate, or a change in estimate that's indistinguishable from a change in principle. So if you have one of those where they've changed the depreciation method, you've got to do what? You've got to sit there and put the emphasis of matter, the explanatory paragraph. Okay. Now let me ask you this. Let's say I tell you that an asset has a 10-year life. I depreciate it for 3 years, assuming it has a 10-year life. And then after the end of the 3 years, I decided it only had a 5-year life. So now I'm going to just depreciate it what? I'm just going to depreciate it over the remaining 2 years. Would that warrant the emphasis of matter explanatory paragraph?
I'd say no, you're just changing the estimate of the life. You just got new information, basically.
Excellent. Good. Beautiful. Very good. Okay. That is not a change in principle. That's a change in what? Estimate, right? Now, under the accounting standards, both situations, changing from declining balance to straight line and changing the life from the accounting standpoint, those are both what? Those are both considered change of estimate, but the auditing standards have required that the first one, the change from declining balance to straight line, that one you do have to include in the emphasis of matter explanatory paragraph. The change in the life of the assets, clean change of estimate, handled as such, both from the auditing and the accounting perspective, does not require the emphasis of matter explanatory paragraph. Good. Correction of an error in principle. Yeah, you got to fix that, and it's got to be called out in the audit report. Change in entity. Yeah, that has to be called out in the audit report, and you'd have to restate the prior year statements. Correction of a material misstatement. Yeah, that's got to be called out in the audit report. A correction of a previous misstatement in previously issued financial statements. Okay. Okay, good. And if an entity includes statements, include a significant investment account using the equity method, then you would have to include that. Okay, so just flashcard those. Okay. Okay, good. Come over and Other changes in accounting estimates do not affect the auditor's report. Okay, so again, that one that is indistinguishable from change in principle, other change in estimates do not, like the second one I gave you when you change the life of the asset. Okay, all right, now they give us a summary table down here. We already flashcarded those, but you can go ahead and shrink this down to a flashcard. And by that, I mean you can take this page and take it to the copier and your copier and make it smaller. It fits on a nice flashcard, and it's a nice little set of check boxes. I don't expect you to memorize this whole thing, but it might not be bad to kind of scan through those from time to time. Okay, good. Let's go ahead then with all that, and let's take a look at a couple multiple choice questions. You're on watch, guys. I'm watching you to see if you're trying these questions. Don't make me go through that again. Calling out everybody, okay? Okay. Go ahead and make your selection here. So I'm getting 3 and 3 is 6 and 9. We've got 11 participants, one of who I think is missing. So there's one person that's here that doesn't like to answer. Okay. All right. Let's go ahead though. We're getting close in terms of the level of participation. And okay, C is the right answer. Now you look and you're like, okay, 38%, that's not good. But we're getting there in that we got what, if you add C and D, we've got, what's that, 63 or 73? 63. Okay, so we're still a little behind the 8 ball here. But the choices C and D, at least we know that we would be giving what, unmodified opinions. But let's understand why, oh, wait. Actually, D is the correct answer, but I understand why a lot of us made a mistake on this one. So let's just take a look. Okay, so, and I'm just going to close this poll out of the way to get it out of the way, just so that when you look at the lecture later, it's not there. You can read that. Okay, so let's just take a look. And management of a non-issuer believes that the auditor is satisfied that a material loss probably occur when pending litigation is resolved. Management is unable to make a reasonable estimate of the amount or range of potential losses, but fully discloses the situation. Now, the auditor is satisfied, meaning the auditor got the evidence they needed for what was disclosed, and management fully disclosed the range. Has management followed GAAP here?
Yes.
They followed GAAP. The GAAP rules are, hey, if you don't know, disclose the range, and the auditor is satisfied. So the auditor got the information they need. So we're heading towards what? We're heading towards a unmodified opinion, okay? But if they fully disclose the situation, should it be in an other matters paragraph or emphasis of matter? The situation has been fully disclosed. Should it be other matter or emphasis of matter?
I'm not sure. I don't think
Okay.
they may not need it at all.
Well, hang on. Emphasis of matter is emphasizing something that's already been stated, isn't it? Emphasis.
Yeah.
Let me put emphasis on the fact that I've told you to do your homework. Do your homework. There, I just put emphasis on it. Okay. So that means that what? It's something that's already been talked about, and we're emphasizing it. We're making an emphatic statement by doing what? By putting it in the audit report. So that clearly, if it says it's already been disclosed, then that clearly means it is what? An emphasis of matter issue, not an other matters issue. Other matters are things that weren't disclosed that the auditor is bringing to the attention. So management followed the rules, it's unmodified, but it's not other matters, it's what? Emphasis of matter. Thus, D is the most correct, and that it is an unmodified opinion. Emphasis of matter is still unmodified. It's just that you add the emphasis of a matter paragraph, but you wouldn't put that under an other matters, it would be under emphasis of matter. Okay, it's not unqualified. I mean, it's not qualified, excuse me. Okay, good. Let's try this one. You kind of see, guys, how they make these questions tricky with the wording. The concepts are not that difficult, but you're going to have to go the full 15 rounds with the flashcard, and 15 rounds is a boxing term. I don't even know that they use 15 rounds anymore. That for 12 rounds, whatever it is they do now, that you're going to have to sit there and do the full work with the flashcards. And once you do that, then you start to really strengthen your ability to pass this auditing exam through the repetition, through the flashcards, through the looking, through the trying the questions, through the get them wrong, then you get them right, and slowly you get closer and closer to that promised land where you're going to knock out the questions on the auditing exam. I predict you're not going to have a time constraint. You're going to be in good shape in answering these questions, but you got to put in that upfront work. I got 7 responses out of 11 of you. Okay, let's go ahead and let's take a look at this one. Okay, and okay, we're at 50% in this question. So for which of the following events would an auditor issue a report that omits any reference to consistency? Okay, now what happens? We sit there and we assume that there's consistency unless what? Unless there's a change. So the only time that we mention consistency is if what? Is if there has been a change. For which of the following where we omit any reference to consistency? So it means that for 3 of these, we're going to have to mention that there's been the change in accounting principle, right? For the one right answer, we would not be responsible for adding an emphasis of matter explanatory paragraph that talks about the change, right? So let's go ahead and let's take a look. A change in the method of accounting for inventories is the first one. Is that a change in principle?
Yes.
Changing the method of accounting for inventories, going from weighted average to FIFO? Yes, it is. It's a change in principle. So we'd have to mention that change, right? Okay. A change from accounting principle that is not generally accepted to one that is generally accepted. Yeah, that's a change that has to be mentioned. That's explicitly right off the flashcard. A change in the useful life used to calculate the provision for depreciation expense. Hang on. Change in useful life is not seen as what? A change in estimate. Change in useful life is not seen as a change in method. It's seen as a change in estimate. Therefore, what? We don't have to mention consistency, right? Management's lack of reasonable justification, that's going to require that we do what? That we issue a qualified opinion, isn't it? Okay. Okay. What's today? Monday?
Yeah.
Okay. I don't know. Talk to me, guys, because I feel right now like I don't know. Right about now, I feel like I'm just walking through cement here, through wet cement, through a brick. I feel like I'm dragging a brick wall behind me. What do you want me to do? You want me to let you look at the rest of this on your own? I don't know what you want to do here.
I'm appreciating what you're doing. It's helping me. I'm trying to follow.
Oh, I know you are. And I know other people are trying to follow too, Matthew, and I appreciate everything, your interaction, but I'm feeling like at this point, we're just kind of going through the motions.
Professor,
Okay.
can I ask something?
Huh?
Can I ask something?
Yeah, sure.
So basically, I noticed the page number kind of like different from what you are showing us here compared to the one that we downloaded on online. And also there was one section, number 2. Hold on.
Well, wait, let's deal with these one at a time. Wait. Let's deal with these one at a time. So you're saying that this page numbers are different
Yeah, I'm not sure if the other
than
one.
what you downloaded? Because,
So
let's see.
number
Let me
8.
see. Because this says a version 3.5 audit 1 textbook. Is that what yours says?
Mine is 4, V3-4.
Okay,
Yeah.
so let's look back at Canvas. I mean at e-learning. So maybe I posted the wrong one up there. V35A1.
Oh,
How did you get 4?
I downloaded from the e-learning, but I downloaded before the class started. I'm not sure if you updated.
I did.
But-
I updated the new ones.
Oh, okay.
So it's okay. Just going forward, use version 5 and throw away those other ones, delete those other ones and use version 5. You don't have to worry about it tonight because I know it's a little annoying, but I think we're far enough along in the class. Just roll with it now rather than try to change it now because probably do more harm than good. Okay. What was your other question?
Well, at first I wasn't, you know, I say the page number is okay, but then because version 4, number 2, automated paragraph with the report requirement, they have 3 bullets and this one had 2. That's why I think I should ask, but maybe you say that I should disregard.
Yeah.
Yeah, I will.
Yeah, you use version 5, whatever 2 is saying.
Yeah.
I mean, version 4 is saying is not relevant.
Yeah.
Not, I mean, I don't know if it's not relevant, but we don't want to use it. Okay.
Thank you.
Okay. Okay. Anything else? I mean, any other thoughts? Okay. Do you want to stop and you want to pick up here next time? What do you want to do?
Can we keep going?
Yeah, I'm
we
still
can
learning a
keep
lot.
going, but I'm kind of like feeling like, you know, something's wrong, but okay. All right, well, let's keep going then. Maybe it's just, maybe I'm having a moment of doubt here for no reason, okay? All right, so let's just go ahead and let's keep going, okay? And now we're going to talk about reporting on comparative financial statements. And we're going to, you know, understand that a company, when they prepare their financial statements, they'll generally show you 2021 in one column, right? And 2020 in another column to show you comparative statements. Now, what happens? Let's say that in the first year, say XO, okay? We'll just call it a more generic year, XO versus X1, right? Just to make it a little more generic, okay? Let's say that in XO, everything was fine and the company got an unmodified opinion, okay? But let's say that in X1, okay, there was some problem and the auditor qualified the opinion. Now, when the auditor writes their report, when they put their opinion, the opinion will cover both periods. So how are we going to write a report in which we're trying to say everything was okay in the first year covered in these comparative statements, XO, but there's a problem and we're qualifying our opinion for X1? Well, it's not that difficult. It's almost common sense. When the comparative financial statements are presented, the auditor should refer to each period that is being presented and on which an opinion is expressed, okay? Because the report date of the audit for the most recent financial statements is used, the auditor should update the auditor's report on the financial statements previously issued. Update means essentially reaffirming, or it can mean change the original opinion from that was originally issued, okay? Now, again, the opinion's covering both periods, and let's say we're not going to have to make any changes to what we had said about the opinion being unmodified for XO in this example. And since we're now in the situation you see here that we have different opinions, the auditor may express a qualified or a adverse opinion or disclaimant opinion Include an emphasis of matter, explanatory paragraph, with respect to one or more of the financial statements or for one or more period, while expressing a different opinion on the financial statements of the previous period. Okay, so you take a look and let's see how the report gets structured when there's an unmodified prior period year with current year qualified. Is that what we just did up there? Prior year unmodified, current year qualified. Okay, so let's see how you'd handle that situation right there that I just put there. So what happens? Introductory paragraph, same. Management's responsibility paragraph, the same. That rarely changes. Auditor responsibility paragraph, almost the same except for that little sentence that was down there all by itself. And that now you'd have to say, hey, it's a qualified opinion because what? Because year 2 in this example, X1, which is year 2 in this example, is what? Is being modified now, is having a qualification, okay? So look, guys, it's real easy. When you get into the basis of the qualification right here, notice that you call out the problems for what? For 20X1. I mean, everything you say there, I'm not going to even read what the problem is. You're saying X1 was where the problem was, right? 20X1, 2021. You know, X1 year had the problem because that's what the qualification related to. And then when you get to the what? Do the opinion paragraph, in our opinion, except for the effects on the X1, whatever it is they did wrong, we're giving you a qualified opinion. And the rest is exactly as you memorize for the unmodified, the financial statements referred to above, present fairly, etc. Okay, so it's very simple. For whatever year you had the problem, that's what you talk about where your problem was. And for the other year where you don't have a problem, you say XO was fine before and still is fine. It's just X1, they didn't do something that we've already told you about in the basis for the qualification. Okay. Question? Now they give us 52 examples of different situations where there might be a, you know, qualified in one year and unmodified in another year. I don't care. Whatever the problem is, you isolate it and talk about it as it relates to whatever year you're talking about. We don't need all these examples. Okay, okay, good. Come over and updating prior opinions. So what happens here? Let's say I have to give you a qualified opinion. You're on the board of directors of a company. And I say, look, there's a problem. They didn't follow GAAP. We're going to have to qualify the opinion because there's not time to fix this. If you sit on a board of directors and that company, let's say you're on the audit committee of the board of directors, and that company gets a qualified opinion, are you happy?
No.
You're none too happy. So what are you going to do? You're going to turn back to your CFO, your CEO, and say, what the hell? What's going on? Well, talk to me about the problem. What do we got to do to fix this, right? And so what's going to happen? The CFO, the CEO, the corporate governance structure has kicked in, and they're going to say, we better figure this out or we're not going to be working here anymore, right? So they stay up late, they work hard, they push their staff, and they figure out why something wasn't accounted for correctly, and they fix the problem. So you get on the phone to the auditors and you say, hey, auditors, can you come back and take a look at these financial statements again now? We think we've fixed the problem. And you come back as the auditor, or whatever, the auditor comes back. Now I've got you being two people, the board of directors and the auditor. You come back as the auditor and you look and you're like, oh, okay, yeah, we're satisfied now. Can you change your previously issued opinion?
I think so.
Yeah, why not? They fixed the problem, didn't they? They don't have to stay in hell forever, okay? They've atoned for their mistake, okay? But now, when you change your opinion, okay, when you change your opinion, you are now seen as a dork. Okay, only dorks, right? That's kind of cute. Let's go ahead and use that one, because that's a cute one. Only dorks change their opinion. So what will you do? When you revise your opinion, when you update your opinion, that means you're revising it because now new information has come to light. You'll give the date of your previous report, the type of opinion previously expressed. Probably you're saying, hey, we qualified before. Reason for the prior opinion, they didn't account for some assets correctly or something, but changes have occurred. They've gone and they've researched and they've now seen the correct accounting. And so now my opinion is, and you'll probably be changing it to unmodified, unqualified at that point. Okay, so that's what you'll have to do in the report. Okay, and they show an example of how you would apply the dorks in an example report there. Most important thing is for you to remember to follow those rules if you have to change it. Okay, okay, good. Now, reporting with a predecessor auditor, what happens here? So let's say that you audited 2020 financial statements, and then the client decides to change me and I'm going to audit the 2021 financial statements. In that situation, you would be the predecessor auditor and I would be the successor auditor. Okay. Now, I'm going to come to you and I'm going to say to you as the successor, look, I'm getting ready to issue the 2021, 2020 comparative statements. And I would like to just present your report alongside mine. So I will go ahead and I will present your report. Your report will sit there and you will cover 2020. I'll cover 2021. Would you allow me to do that? Would you say, sure, John, go ahead. I audited 2020. You can put my report there. You audited 2021. You can put your report for 2021. Would you do that? Okay. And the answer is what? In deciding whether you're going to reissue the report, in deciding whether you're going to let me do that, you're going to say, well, wait a minute, I got to do a few things before I allow that. Okay. So let's flashcard what you need to do in order to allow your report to be presented alongside the successors. You have to read the statements of the current period, 2021. Compare the statements with the current statements with the prior period statements. If you see a big change there, now you're maybe looking at your statement saying, what the hell happened? What's going on? Was it wrong last year or is it wrong this year? But I got to check that out. Okay, then what? Obtain a representation letter from me, the successor, that says I'm not aware of any problems with your financial statements. Because remember, I'm seeing the financial statements from the previous year, but now I've got 365 days of hindsight that maybe indicates to me there was a problem, and I'm not allowed to say, let's let this guy reissue his report, even though there's that mistake in there. So you get a letter from me saying I'm not aware of any problems, and management got to give you a letter saying that they're not aware of any problems with the previous year's statement. And what happens? If they do all that, then you will allow them to go ahead and what? Reissue your report. Now it could be issued unrevised because you didn't see any problems. But if there's a problem, you may what? You may wish to revise your report, and you'll probably use a technique called dual dating that we'll talk about later. Okay. All right, good. So flashcard what you need to do to allow your report to be reissued. Okay. And then come down, and what happens if your report is not reissued? It's not reissued at all. You say, no, I don't want you to present your report with my report. Well, now it becomes the burden of the successor. The successor auditor will be the one that will sit there and add in other matters paragraph that will talk about the fact that there was another auditor involved, but they're in the previous year statements, but their report has not been presented. Okay, so when we say not issued, that's another way of saying not presented. Now, what am I going to do? I'm going to tell you, hey, other auditors were involved and their report is not presented. Okay, and I'm going to make that statement in an other matters paragraph, but make sure you put sort of a flashcard inside the flashcard here, because you're flashcarding what the successor should do if the other auditor's report is not presented. But I am not supposed to name you by name unless I have your express permission to do so. And so what I'm going to do is I'm going to add an other matters paragraph, and I'm basically going to summarize what happened with your report. Okay, so I'll say, hey, the type of opinion that was expressed by the previous auditors was modified, unmodified. If there was any emphasis of matter in your report, what was it? Okay, if there was a qualified opinion, how come? And what was the date of your report? Okay, so I won't present your report. I'll simply add another matters paragraph that will click off this checklist of things, but I don't name you specifically at that point. For whatever reason, you've decided you don't want your report presented, and so I don't name you. Okay. Okay, good. Okay, now what happens if they tell us prior period statements were not audited? Well, what does that mean? So let's say 2020, the company gets an audit, but and they're doing comparative statements, but the 2019 statements were, say, just reviewed. Reviewed, and we're going to talk about this in Audit 6, is a lower level of service than an audit. Meanwhile, I've got the financial statements side by side with audited statements. And again, there's a concern that the user of the financial statements will get confused and think that both years were audited. Meanwhile, 2019 did not receive as much scrutiny as you would have under a review than you would have under an audit. Okay, so if that's the case, okay, what's going to happen? When the current period financial statements are audited and presented in comparative format with prior period statements that were reviewed, compiled as even a lower level of service than an audit, and the audit report is not reissued, meaning we're not going to show you last year's report, the auditor should include it in other matters or explanatory paragraph if we're talking about a issuer, and you're going to have to include the following, which you should flashcard. Okay, the service performed in the previous period, what was it? The date of that report, the description of any material modifications described in that report, and this is the most important part, a statement that the service was less in scope than an audit and does not provide the basis for expressing an opinion. So essentially, you're disclaiming an opinion on the earlier year statements because you weren't able to audit that. And you do that in what? In an other matters paragraph, okay? Now, or explanatory paragraph, we're talking about a public company. Now, notice what's going on here, guys. We're sitting here and we're giving you detail on the reasons for the either emphasis of matter or other matters and how you're supposed to handle it. We're giving you the specifics. So that long list where I said, all I want you to understand from that long list is when you're required to do emphasis of matter, other matters. What we're doing in this section is we're telling you, okay, here's what that other matters, emphasis of matter paragraph will actually look like, or explanatory paragraph if we're talking about a public company. Okay. Okay, good. Come over, and if the prior period statements were not audited, reviewed, or complied, in other words, what? There was nothing done on those, then the financial statements need to be marked as such, and they'll be in other matters paragraph indicating that there was no audit review or compilation. Okay, so, and you take no responsibility for them. So if they didn't even rise to a level of compilation or review, other matters, explanatory paragraph saying, hey, there was really no accountant auditor involvement with those statements the previous year. Again, we don't want to run into the situation where users pick up the financial statements, pick up our report and think it's covering to the same degree all reports that are concluded in those comparative statements. So we warn them in other matters, emphasis of matter, well, for these, it's other matters, paragraph or explanatory paragraph if it's a public company. Okay, good. Let's take a look at this couple next questions.
I have a quick question.
Yeah.
So in Alaska, for most of my clients, we actually prepare the financial statements for them.
Mm-hmm.
And I'm trying to think of a situation in which you would have a prior year, balance sheet and income statement that wasn't even compiled that you would want to present.
If for some reason you were sort of, I'm thinking it's generally going to be in the situation with the company that's, sort of a startup type company that maybe was in some early rounds of funding. And so they maybe even weren't, sitting there and getting up to a situation where they were having significant involvement with an outside, third party accountant. And now they're getting to the point where maybe they're going to some later rounds of funding in a startup type situation, and they've gotten involvement of an accountant. And you're looking and you're saying, well, we're going to go ahead and do comparative statements because there are statements from the previous year, but the third party involvement is really going to be kind of starting this year. Does that make sense?
I think so.
Yeah, because they're getting more serious about their accounting essentially, because sometimes that'll be the case is they'll wander the earth with their accounting for a while. And sometimes in some cases, as they move up in the maturity level, they'll fire the entire financial staff and say, okay, now we're going to bring in some people who actually know what they're doing, who are a little more sophisticated in what they're doing anyway. And so they'll turn around and the new people will say, hey, we don't care. We're not going to go back and start, fixing things that weren't particularly relevant to where we were at that time, but we're going to set the stage now. And this sort of becomes the watermark where, okay, now we're going to go forward. And now from now on, there'll be some review or compilation or something like that. And then, then you'll start to move up the food chain from a compilation to review to an audit. So, it's probably earlier stages where that would be the case.
Okay, thanks. That helps.
Mm-hmm. Okay, let's go ahead though, and let's relaunch this poll. The other thing I was going to say though, where I thought your question was going, and it's probably worth noting, sometimes a company will say, well, look, we want an audit, but we really don't have the sophistication to prepare the financial statements. So we would like you to compile the statements for us. And we want an audit. What are you going to do? You can go ahead and compile the statements using their GL, whatever, to compile the statements. And then you would go and get corroborating information for what you see in the GL by confirming accounts receivable and, doing whatever else you have to do, observing inventory. You start to look at invoices. You get behind what's behind the GL. And since you've done audit procedures, then you issue an audit report because you issue the report to the highest level of service you had. So even though you may have engaged in compilation services and audit services, or compilation service and review services, you issue the report for the highest level of service you provided. Okay. Okay, guys, let's go ahead and look at this question. And our batting average is improving, but it still needs a little work. We're at 70% here. I'd like us to be working around 75%, but most of us got this question correct. Okay, so let's go ahead and let's take a look at this one. A is the right answer. Okay, and when reporting on comparative financial statements, an auditor ordinarily should change the previously issued prior year's financial statements when what? When the financial statements are restated to conform with GAAP. You'd say, excuse me, the date of my original report was this. The opinion expressed was a qualified opinion. Reason was they had some mistakes. Changes have occurred. I'm going through the dorks mnemonic. They have fixed the problem. So now my opinion was what is now unmodified. That's what this is describing, right? They fixed the statements. You can issue a different opinion. Question? Okay, good. Let's take a look at question 2. Okay, guys, let's go ahead and look at this one. Okay, make your best shot at this point. I'm going to end the polling. And most of us got this right. Okay, the answer here is C, so that's a good response. Okay, good, correct response rate. So let's just go ahead and look at this one though. And you can see here that a comparative statements include the prior year's statements that were audited by a predecessor auditor whose report is what? Not presented. If the predecessor's report was unmodified, the successor should do what? And we simply do what? We add another matters paragraph that describe what was in the predecessor auditor's report. So indicate in other matters paragraph, the predecessor auditor expressed an unmodified opinion on the prior statement. So you just simply summarize what the predecessor had said. That's what the successor should do. Okay. Okay, I'm going to stop there and we will finish up chapter 1 on Wednesday and we'll start chapter 2. So we're a little bit behind, but I think we're okay where we should be able to, you know, keep going and be in good shape here going forward. Okay. Questions, guys?
I have one quick question.
Yeah.
So I have printed flashcards from 2018. Do you think that those would still be relevant to study with?
No, unless they say the same thing that we've said before. So you're gonna have to kind of
Look at each one.
yeah, you're gonna have to, what's the word? You know, cull through those and pull out, you know, extract out the ones that are no good or extract the ones that are good, however you want to look at that. So it gets a little tough. What you could do as a quick way of doing that, you have the current Becker stuff that came with the course here, right?
Right.
So you could go through flashcard by flashcard quickly, and if they're the same, keep them. If you don't see it or it's changed, get rid of it.
Okay, because we have access for the online flashcards.
Yeah,
Okay.
yeah, that came with the package.
Okay, perfect.
So you could quickly do that. That'd be the fastest way to do it, and it's not, you know, it may sound like a waste of time, but it's not really, because you're having to look at the cards and think about how they connect up. So you probably get some, you know, strengthening benefit that way. And then you've got the printed cards. And then there's also groups of cards that I call out that are not in the Becker version of the cards. So you're going to have to make those, because I don't always think the way they do about how to summarize the key aspects. And when I look at it, I'm like, this is something that you got to know. And then sometimes they don't put a flashcard for it. And then other times you'll see things that they have as a flashcard that I'm like, why would anyone want a flashcard of that? So I'm not telling you flashcards that I've already seen that Becker's made, and I'm just telling you here. These are flashcards that when I look at a page of material, let's say, in my judgment, how would you not know that and think that you're going to be successful on the exam? Or I'm taking a strategy of memorize the opinion and then memorize the exceptions when you have a qualification or something to each paragraph of the unmodified opinion. I don't know that they take that approach, or at least when you look at the cards aren't articulating that that's the approach that they're taking. So
Yep, nope, I'm definitely going to do your flashcards. And after having just studied for FAR, while the flashcards are nice to have, some of them are very poorly written or just not relevant.
yeah, what they do with their flashcards is they put the book on flashcards. Well, that's not the point of a flashcard. The point of a flashcard is what? Here's what you got to know, right? right? Going in, and these are things that you should probably know, and these are things that are nice to know, right? And you can kind of tell when I keep emphasizing something over and over, okay, I got to know this stuff over here. Okay, I guess I'll keep it in a pile that's good to know, that kind of thing. It's kind of hard when I'm not physically with you guys, because what I've done in the past is I've literally gone through someone's flashcards and I put them in those piles for them, but we're kind of limited what we're able to do here. So, but try to do that exercise.
Okay, well, thanks.
Okay. Anything else, guys? Okay, good work. Hope you don't mind me pushing you, but that's what I'm here for. I'm doing two things. I'm your teacher. I'm doing three things. I'm your teacher. I'm going to grade you. But most important part of my role, as I see it, is I'm your coach. And so I'm going to keep pushing you to get you to that athletic ability to get this exam passed. Okay. All right, guys. I will see you on Wednesday. Have a good rest of the evening.
All right.
Thank you.
Chris.
Bye.
Thank you.
Thank you.
Bye-bye.